So interpreting implied volatility. So this graph right here, I took this right off of our website. If you wanted to go and look at our implied volatility charts, I used one. The stock A has a lower volatility. You can see that the range here, it's probably hard to see, but on the left here, you can see that the range is, 7 to 12, right? So we have a volatility that is 7.5 to 12 at the highest. So that means that we've got some stability in this. This is likely to be some kind of utility where we don't see the same kind of price movements that we see in some of the others. Whereas stock B, you can see, is far more volatile in terms of the volatility range here, 52-week volatility range, where it's 19, and as high as almost 38 there. So in those 52 weeks, we can see between these two a dramatic volatility change for them. And so the reason why that's interesting is because of what your potential outcome is. Now, if you were, if you are less risky, then you might choose the options that are less volatile. And if you're willing to take more risk, you might trade options that have more implied volatility in them. Now, here is an example. It has to do with standard deviations. Standard deviations. Oh, sorry about this. I've been asked to turn my camera back on, so I'm going to turn it back on. So anyways, let's assume the stock is currently trading 100. The annualized implied volatility is at 30%. So one standard deviation move. So I would expect that standard deviation move would be $30, whether that's up or down. So one standard deviation, I'm looking at a range of $70 on the downside, and on the upside, somewhere at 130, right? So if I'm measuring risk in my options, I'm going to be looking at that one standard deviation move. So down, if it goes down one standard deviation, I'm going to look at risk between 100 and 70 to see what that looks like. And on the upside, I'm going to be looking at risk between 100 and 130. Now, when market makers, when their risk is evaluated by their clearing firm, this is what they use. They'll use, typically they're looking at 3 standard deviations out to see what that risk is that they're holding to determine whether or not they have the capital to hold that kind of risk. So when you're looking, if I would just move down to 3 standard deviations out, so we know that it's 30%. So 3 standard deviations means that the stock has a potential of going down to $10 or going up to 190. So when we're measuring risk, that's what we would be looking at. And of course, 3 standard deviations out, is, basically that, that hurricane, that huge hurricane that's supposed to happen once in 100 years, which is why you have that probability of less than 1% of it moving 3 standard deviations